Will gold or treasuries cause the next dollar crash? Will there be another dollar crash? We're going to get into all of it, some crazy price action in that US dollar. We're going to look at euro dollar. We're going to look at dollar yen. And we're going to also correlate all of it to the recent big moves in gold and treasuries. I brought this to you yesterday, Paul. I said, let's talk about some gold correlations. Everybody's talking about gold, obviously. It's like the S&P of 2 years ago, where it's like new all-time high, new all-time high, new all-time high. You can write the news story every single week. Gold has kind of backed off of those all-time highs at the same time that U.S. dollars kind of found a bottom. And you came back to me and you said you wanted to talk about treasuries. Do you think that treasuries is more of a correlation story, before we look at the numbers, than gold?
I think treasuries and dollar yen are very interesting. There's a lot of structural trades that go on based on yen and treasuries, and you go into the weeds, you can get lost pretty quickly, but it's a pretty interesting kind of area. We won't go too far into the weeds there. We'll get quite complicated.
Well, that's why we have you here, is to go into the weeds. Yeah. And also, it's like Frank comes to the table with, I want the flashy story. I want to talk about gold, and you come to the table with the more statistical. I'm a gut guy, you're a stat guy. And I appreciate you helping us out with that, keeping us grounded. I did run a bunch of correlations for us, so I'm not just the flashy guy here. But looking at the US dollar basket compared to gold over the last 10 years, you see a couple of things, Paul. One, it's red all the time. That means that the correlation between these two markets has been inverse every single month going back to 2015. Now, you would expect that, of course, but even some of the strongest relationships, you see flashes of weird markets. And so I was ready for, at certain periods in maybe 2022, or especially around the pandemic, you get a lot of weird data prints around March of 2020. Surprised to see no positive correlation at any period between gold and dollar here. Are you also surprised to see that it's been some of the weakest correlations in 2024 that we've seen in this whole data set?
Yeah, that's the interesting thing. It's kind of an interest rate dynamic, I think, because as interest rates have stayed high in the U.S., that obviously has led to dollar appreciation against the rest of the world, which is how the dollar basket is calculated. But interest rates are high because inflation's high, so people use gold as an inflation hedge. So it's all kind of a self-fulfilling prophecy there. So there's a little bit of that. What I think I'm the most interested in right now is this correlation, this negative correlation starting to get stronger. Yeah. That's the key kind of takeaway. And you can see the chart. It gets weaker and then it starts to get stronger again, and it gets really strong at some points. So. And
you could see a couple of things here. Is the correlation has been as weak as about negative 0.25, which is like pretty weak correlation number, where if you're looking for something that's strong, you're usually looking for something that's more than 0.5 in either direction. Yeah. That being said, we put in that low correlation here, like you say, kind of weird dynamics at certain times, where inflation is there. It's causing interest rates to move higher, but it's also maybe causing some gold demand at the same time. It seems like we're maybe away from that dynamic, or at least the market has started to move away from that dynamic as interest rates have moved lower. US dollar, like I say, it has moved off of its highs. Gold has not necessarily, but you see in the last couple of weeks here, and if you've been watching markets, you've seen in the last couple of weeks as we conclude April, gold coming off of its highs a little bit, and US dollars seeing some bounces, and that correlation is getting a little bit stronger. And I do point out that before we put in these low correlations, some of the lowest that we've seen historically in 2024, in 2023, you did see some of the strongest inverse correlations. So we could move back to that. I wanted to layer on two charts here. In the black line, you've got gold, Paul, and in the backdrop there, the candlestick graph, you've got euro dollar. So again, we just showed you an inverse correlation between dollar and gold. Now, since we're looking at euro dollar and gold, likely a positive correlation between that euro dollar and gold market. And you can see here the rise in gold from where it kind of stalled out in 2024 after it's been, I mean, I say stalled out, but these are all, new all-time highs. And then it kind of stalls out a little bit, and then we see another big run here to start 2025, very much in line with that big run that we saw in Eurodollar to the upside. And I think this is where the correlation has actually started to get stronger, right?
Yeah, you saw it start to pick up steam. I mean, as soon as the tariff tensions, obviously that means people fled away from the dollar, and where do they go? Well, some people went to euro, some people went to gold. Treasuries not so much. It's again a different dynamic, but you saw this market catch up to gold. I think that's kind of saw the catch up in the correlation, and a lot of these things that we know are correlated, they'll catch up really quickly, especially when the correlation hasn't been working for a while. So that's what you kind of get here. Obviously, there's a ton of dynamics that have led to this. Obviously, the tariffs, the different interest rate moves, the EU kind of seem to be weathering their storm as far as on the economic front. So it's an interesting kind of catch-up trade that the euro's put in here.
Yeah, you've seen gold for the last couple of years have, in certain parts of its trip through all-time highs the last couple of years, be correlated to equity markets. And we haven't actually seen that in 2025. And actually, if you look at the last 30 years of data, you don't see that most often, a positive correlation between gold and equities. In fact, if you go back to pre-pandemic, a lot of times you see gold listed right there with bonds as a flight to quality trade, right there next to yen, which we'll get to in a second. You're starting to see that take place a little bit here again, like you say, around tariffs. And it's funny that we never know what the catalyst is going to be for a correlation kind of coming back in line, or a market relationship coming back in line after it's been, aloof for years. And this tariff stuff might be the catalyst for gold, again, becoming a little bit of a risk-off trade, a little bit of a flight to quality, because we've seen the rise in gold correlated at certain periods with falls in equities and falls with this U.S. dollar. So the correlation growing there. I do want to get to Paul's piece here, which is U.S. dollar relative to Treasury prices. And again, you have an inverse correlation. Interesting to, and this is kind of my point earlier, is like you do see these flashes of positive correlation, which it doesn't make a lot of sense to the textbook economist. You would think that, if Treasury prices are rising and U.S. interest rates are falling, there would be less dollar demand. But you do get these wonky markets like we did in 18, 19, or in 2021, where there are flashes of it. But to your point, Paul, actually right now, coming off some of the strongest correlations that we've seen between these two markets in the last 10 years. Yeah,
again, what's the dynamic that's kind of caused some of these correlations, and some of the correlations actually weakened towards the kind of the recent months, which is a real interesting story. But so kind of what you saw there, if you look at, there's a big spike down, this correlation gets super negative kind of at the beginning of this year. So there was kind of this worry that deficit spending was going to get really high, that basically the U.S. interest rates are going to be higher on the back of that. U.S. has more debt to service. Interest rates go up in general. It's like a company with more debt would. Mm-hmm. But then this starts to back off. Kind of the last month or two action we've saw in treasuries has been probably the most volatile I've ever seen in my life.
Very crazy price action in treasuries.
There's a couple nights where you get a 30 to 50 basis point move in 10 years, which is unheard of overnight. You get a bunch of traders like me watching 10-year prices at 10 o'clock at night, which is, we think we should probably be going to bed, but we're still sitting there looking at our phones. But yeah, there's a number of things. There was a basis trade that's kind of got unwound, that took some hit into the treasury market, but that didn't really play through the dollar, like an unrelated story. So there's a lot going on there, and it's kind of interesting to see how this correlation's been playing.
Well, I'm glad you brought that up, because one, when you bring up unwind, I'm almost always ready to talk about dollar yen. And two, this price action here is where the correlation is starting to break. Like you just said, the correlation is actually getting weaker here. It's getting stronger between dollar and gold, getting a little bit weaker between dollar and interest rates. And you see here where dollar is putting in its lows against yen, and those 10-year yields are actually spiking here at the start of April. Of course, historically we've seen this dollar outperforming as interest rates rise or as U.S. Treasury prices move lower. But yeah, really interesting to see that the 10-year, dipping to 4%, correlated with that big dollar sell-off, but then bouncing off of that 4%, not so much correlation. And that's, of course, because of the interest rate differential between a lot of these places. You likely saw interest rates bouncing in a handful of regions like Japan, Euro area, and what have you there to start April, correlating to that U.S. dollar, not necessarily bouncing in the same time. I do want to close out with a couple of takeaways here because we do have gold at these all-time highs and the correlation getting stronger between gold and dollars. So if you think gold is maybe going to move through those all-time highs, that long dollar position might not be as attractive. Or if you think gold is going to move through those all-time highs and you like a short dollar position, maybe it is more attractive. Now, of course, we do have to say that historical price action and correlations don't dictate the future. But something interesting there on the interest rate side of things, Paul, we are expecting lower interest rates here in the U.S. That said, they're expecting that globally. And like we just showed you, that correlation is getting a little bit weaker. So I don't know if you can necessarily count on the fact that the Fed, the market is expecting the Fed to be 100 bips lower here by the end of the year, is necessarily going to cause that dollar collapse. What say you? Of course, again, one of these things, we don't know what's going to happen in the future, and we can't say that if gold does this, dollar's going to do that. But what are you looking at for the next move in dollar, more gold or interest rates?
How about jobs? I mean, if the economy gets weaker, that would be, I think, the telltale side. This is what this market's pricing is, that the economy is going to get weaker and that we're going to have to cut rates. This is not telling me there's any inflationary pressure from tariffs, is what the market's pricing in here. Obviously, that's still up on the table. There's way too much uncertainty. I wouldn't even like this 40%. Like, we've seen this market price in some weird things. I think we're supposed to get like 5 cuts last year, and we got 2. So yeah.
You raise a good point, Paul. Though 40% is the largest probability, I would definitely take any of the other choices versus that 40%, because we might land around there. We have no clue where we're going to land